do a lot of thinking, a lot of working with clients around the impact of digital on their businesses, around, what does digital transformation mean for them? And what I'm very excited about is so many of the topics we'll talk about today are exactly the topics that are being discussed, by carriers, by brokers throughout the industry. What will happen to the value chain? What will happen between the relationship between the carriers and the brokers, between the carriers and the insured? How does AI and various other technologies impact the people inside insurance and broking organizations who've worked the same way for many years and now need to keep up with this incredibly rapid change in how tech works? And then, of course, what does it mean in terms of an incumbent and how they should be working with startups? And, I really look forward to hearing from some of the panelists, both in this panel and some of the later ones, about what you need to do with startups, what you want to do yourself, what's the benefit of sort of looking at things as an ecosystem rather than the classic value chain. So the first panel, we're going to talk about AI and pricing. Clearly, that's at the heart of where Cytora sees some opportunities. So if the panelists would like to come up, and we can get a sense of, do we think the timing is right for AI in insurance pricing? So thank you, panelists. So just a very brief introduction. Richard, who just kicked things off as the co-founder and CEO of Cytora. We then have Mike Hood of AXA XL, who is an actuary within the large insurance risk. So, clearly what we'll touch on today is that there's a full spectrum when it comes to insurance, and there'll be different ways that technology and AI touches these different bits. So we're looking forward to Mike's view on sort of those large, complex risks. We have Suraj Khalik, who's a partner at Atomico, and also a former CTO at Climate Corporation. Now, Climate Corporation has always been one of those companies that sort of ended up on charts 5 or 8 years ago around, here's an organization that knows how to use data in a way that you wouldn't have expected to use data in a particular industry. So we look forward to hearing your lessons from that experience. And then finally, we have Will Hawkins, who's a co-head of European research at KBW. And I think Will has that luxury of being able to take a long-term view in trying to understand how the industry is really changing and what does it mean for the players in the industry as technology starts to drive some real shifts. So that's our panel, and I'm going to dive straight in really with the key question. I'm going to kick off with you, Will. Is commercial insurance pricing ready for AI? Is the time now right?
Sure. Well, thanks very much to Cytora for inviting me to be on this panel. As Paolo just said, by background, I'm a sell-side equity analyst, so I cover the existing quoted European insurers, so the incumbent names that are presumably familiar to you, the Allianzes, Aegons, Munich Re's, Swiss Re's of the world. As a sell-side analyst, it's quite rare that I'm introduced to someone with a long-term view, because people normally think about me focusing on quarterly earnings, but clearly, in order to be judging the performance of shares, you do have to have a long-term view, as well as where the numbers are going next. So, I think the first point that Richard touched on this pretty clearly right at the beginning. AI, artificial intelligence, is a pretty broad church. The term can mean an awful lot of things. Picking up on the definition that I think Richard used really well about machines effectively replacing humans to make the decision, so the human is out of the equation. Yes, definitely, AI is going to be quite transformative for commercial insurance pricing. Although I think, as with all things, there's probably going to be a bit of a timeline here. I think in terms of fully automated pricing and decision-making, I think the smaller end of the commercial market is probably much more ready for disruption than the large kind of complex global risks, which I think are still going to need a lot of human judgment and decision-making. Because I think, well, when you look at the smaller end of the market, arguably very small commercial risks, the technology behind AI is allowing insurance companies to think of them more like the retail market. So long as you're going on the scale side of the business, the typical economies of scale, the mutualization of risk could be allowing a computer to be making a decision in the same way that it could do for a motor insurance policy, for example. And I also think, again, when you're talking about the accumulation of small risks, AI presumably is going to be facilitating the opportunity to micro-segment further existing portfolios, and also to go further into the uninsured part of the market, the micro-insurance market that exists even in the developed economies. The contractors and the like at the moment are still too small to feature in many portfolios. And so I think the last thing that I'd say, there are so many things that are exciting about insurtech and potentially disruptive, but I think one of the things that I find most exciting about this particular theme is that it's a big deal because it's evolutionary rather than revolutionary to the business model. We love the revolutionary stories, and there are some companies on the technology market that are doing revolutionary things. But actually, in a sense, when we're talking about AI's involvement in pricing, you're not really talking about changing the business model dramatically. That may come one day. You're just talking about making the existing model so much more efficient and hence so much more available to hopefully a bigger kind of client base. So I think, again, yes, I think there's loads to play for here.
Good. Okay, so Mike, you're as you say, you're at the larger end, but does it feel like the beginning of an evolution, or actually, is there going to be a revolution when it comes to complex risk pricing through AI?
I'll just start by saying thank you. I mean, it's great to be invited here and to be part of this conversation. It's very exciting times. Yeah, I think talking about large commercial insurance underwriting and pricing. Yes, I mean, I think there are bits of AI. AI is a big field. There are bits of AI which we are already using in that field. In the large commercial space, the decision making is complex, and I think the ultimate decisions that our underwriters are having to make about price and terms are the culmination of perhaps thousands of sort of smaller decisions. So I think there's space for AI to help with those smaller decisions that lead to that final decision about how you can help a client. Yeah, there's a lot of I think there's a couple of areas of AI which are very relevant to large commercial pricing, and which it would be good maybe to talk about and expand on later. But I think natural language processing is something that we're very interested in the large commercial space. And also sort of automated image recognition as well seems to be another area that we see very immediate advantages from adopting.
Thank you. So Richard, clearly you're looking at it in terms of sort of segmenting the potential client base of Cytora. How are you identifying which areas you think are more or less ready for AI within their pricing?
Yeah, it's a really good question. So just to kind of draw on Mike's point of view, Mike and XLAXA focus on very large risks, or at least that particular part of XLAXA. And they're the kind of the way to understand it is they're trying to make good predictions in relation to large portfolios, really, really big, globally distributed risks. The big problem there is the data. The data is the input to the prediction. Where the machine learning can be used, which is a kind of subset of AI, is in connecting disparate data sets together better to get better data to make a better prediction. So I think when you kind of think about how does AI improve pricing, it's really about generating a better foundational data set in which to make better predictions of. And you can break that down even more microscopically. For example, predicting the right location for an exposure is a kind of learning to rank problem where you'll rank different competing locations. That could be the location of a particular site or exposure, and machine learning can help you make a better choice there. So that's, for example, one, I think, very real applicable area where machine learning is being used today in order to build better modeling data sets to kind of allow existing models to work better, whether that's a GLM model that's used in the insurance industry today, or it's a machine learning model that requires a certain volume of data and a certain comprehensiveness of data. The other area that I think can be talked about probably in the mid-market space is setting a more accurate risk premium for a risk based on better external data. So bridging the gap between the expected loss cost and the actual loss cost. And that's another area we have customers working. We work with customers in the mid-market space where they care about the risk premium adequacy. And machine learning can help very much in that space too. Drawing onto kind of William's point right at the beginning, clearly the automation is happening in SME and to an extent mid-market, where it's not just the data that's being automated, it's also the prediction as well, ultimately coming up with a loss cost and a risk premium. So that's how we see it. I do agree that in a large space, it's more helping humans make a better prediction.
Good. Thank you. So Siraj, maybe you can share briefly sort of the Climate Corporation story in the context of the timing question. So you must have, or presumably picked the right time when you did what you did there. How do you think within the insurance industry people should be judging when is the right time to be applying AI?
Yeah. So I think my role here is as a computer scientist turned entrepreneur, now turned VC, where I kind of invest in companies that are primarily using AI for interesting new use cases. Just to recap on climate, what climate it was and is, we were acquired in 2013 as we were probably the first of this new breed of insurtech startups. We were an insurance company focused on insuring companies against bad weather, and that's something that had never been turned into a product that worked at scale before. It's very hard to model with data. There are a number of reasons why this didn't fit into an Excel spreadsheet that a typical actuary might have or would have had in those days. I know things have moved on a little bit, so it was two of us came out of Google. We were early Googlers, and we just thought, okay, this is a huge problem. Let's apply our big data skill set to that. And we got a lot of things wrong, but eventually we built a business that turned out to be a pretty good one. We applied machine learning to how crops grow and what leads to them having a certain yield or not, and then also how that applies to businesses and what their risk is. So we were, in the end, focused on agriculture because it was the biggest vertical, and we're selling to farmers saying, okay, based on what you're growing and all these inputs, you should be doing this or this, and then this is how we insure you against adverse outcomes. And that business was built on machine learning. We would not have succeeded if we hadn't done that. There's no way a rule-based system would have worked. So that's really the reality today is when you think about AI, it's a very loaded term to people who are computer scientists like myself. AI is actually meant something very different to the way we're using it today. But it is worth drawing this distinction, which I think Richard alluded to, of shallow versus deep AI. And deep AI is maybe a broader topic, but that's not here for a while. But shallow AI is here today, and that's really a way of thinking about making better predictions in a way that you're doing it based on the data itself telling you something rather than having a human interpret the data to come up with imperfect rules to then lead to perhaps imperfect models. I'm a believer. We've seen many businesses in insurance and outside of it that are based on this. The time is absolutely now. And if it's not, then you may not be around to react when you realize it is.
Good, thank you. So one of the questions always on people's mind is around this concern around black box underwriting. Now, what we've already heard a reasonable amount here is, actually it's not just about the AI defining a price. It's got a role, all wrapped around that. But if we can just dive into the pure pricing point of it, just to get a few thoughts, Mike, is black box underwriting a problem for the underwriter, for the insured, for the regulator, or is that actually just a distraction and excuse of people who don't want to be using AI for some of their decision making?
I think in the large commercial space, I think we don't really use black box underwriting today, and there's not many people who are looking for that. I think our underwriters and decision makers are expected to be able to explain why it is they need to charge whatever it is that they feel they need to charge, to explain it to brokers, to explain it to clients, to help clients understand what can they do to change their risk profile, what can they do to reduce their price. We need underwriters who understand what's driving the output from any models that you've got. Maybe not understand everything, but they need to understand what's driving the answers.
Yeah, Richard, would you agree? Is this a distraction or a genuine problem?
I wouldn't say it's a problem. I think it's a reality in a sense. Explainability has always been needed by humans, and if you're buying insurance or you're having to explain why a price is a price to a broker, for example, you need to have information for that. We kind of very much see this as a product area. We kind of produce, for example, key drivers which explain why a risk is scored the way it is, and that might be 5 features that have the most contribution to ultimately the rank of a risk. So it's very, very simple. Those features can be ultimately combinations of things or singular features. They might be, for example, the distance from a fire station. It might be the financial health of a company. That's not comprehensive, but it gives enough information about why a risk might be scored as an A as different from an F. And I do think this is important. I think it's a big area of investment, certainly across the entire world. You think about more and more predictions will be automated and made by machines. If humans are consuming the prediction of the customer of the prediction, they're obviously asking, why is the prediction like this? And it's any kind of complement to the prediction will increase in value. If the cost of prediction is going down, the complement to prediction will probably go up. So the role of judgment is important, and you can obviously think about that in how you build products around explaining why the prediction is the way it is. So we are productizing around this area.
Good. Okay, thank you. What I want to touch on now is sort of the people and the organisational aspect of pricing, how that changed. So maybe a question for you, Will. At a sort of a fundamental level, the people and organisational structure side of pricing has been the same for an awfully long time. You've had underwriters, you've had actuaries, they have a way of interacting. There's a real chance that the introduction of AI is going to sort of fundamentally change that dynamic. It's going to change the role of actuaries. It's going to create a need for data scientists or whatever you may call them within insurance companies. And I wondered if you had thoughts on how the behaviour of the individuals in the organisation as they have to go through this transition is going to be. Will the actuaries fight back and all become data scientists? Are actuaries becoming irrelevant, and it is all about this new breed of data scientists going to take over?
Yeah. So that covers quite a few different points, and I think there are some. Having started off talking about evolution versus revolution, there are some big picture discussions about the role of insurance in the future in terms of prevention versus protection, and how that could be affecting the business model and the people you employ and how they're kind of structured. Parking that point and just focusing on the underwriting subject, I think broadly speaking, the overall management structure of an insurance business is likely to be the same. It's just you require fewer people, and maybe some of the skill sets of those people are going to change. So clearly, the poster topic at the moment is the data scientists versus the actuaries. Again, I think we need to kind of put that in context. Inevitably, at the moment, the marginal hire is occurring with the data scientist because historically insurance companies haven't had them, so they're going to be adding them. Does that mean that the actuarial function is completely redundant? I think, well, almost certainly not. Maybe, again, the ratio may change, the absolute number of actuaries may go down, but, I think, first of all, this may not be the case long term, but dare I say it, there is a little bit of naivety at the moment in the sort of the data science world that, if you get the right numbers in the right order, you'll get the right answer, no questions asked, and that's just not the way the world works. And the good thing internally is, to be fair to actuaries, they've kind of been through a lot of that learning experience already. So I think there's a lot more, institutional humility and sort of, self-questioning on the actuarial side of the business that is a useful counterpoint to the new skills that the data scientists bring in. Also, frankly, again, I don't, in this particular theme, I don't think the actual underwriting business model changes dramatically. And so it is the data scientists that need to fit in and understand how the insurance company works. And that, again, is the value that the actuaries bring. Because, again, at the end of the day, a lot of that is, there's a big overlap. It's just processing the numbers. And the actuaries understand better how that processing of numbers translates into an underwritable risk. At the risk of going off on a tangent, but I think this for me is a very big issue for senior management in companies. I think there is a big internal dilemma about when are you trying to make the existing business model more efficient, and when are you trying to rethink the business model. And it's very hard for one team of people to have that dual conversation because of vested interests, and you can't split your brain that kind of way and the rest of it. So I think one challenge for the guys at the top and that are managing businesses is to actually create a new kind of silo and say, okay, you guys are thinking about how we do the current business better. You guys go out and think a bit more revolutionary, and we'll make the decision about when we flick the switch and how we allocate the resources.
Good, thank you. Siraj, as a programmer and a data scientist, what's your sense?
Oh, that's a good way of thinking about it, because if you're putting everybody into one bucket, there'll be all this political infighting and turf wars, which you don't want. My experience with climate was we didn't bring in any agronomists to build our agronomic model. We brought in people who were PhDs in data science, and it was not initially called data science, but predictive modeling. And some of these people were working for NASA. Some of them were. One guy was measuring the responses of a rat's brain to electrodes and using data science. These people came in and just figured out from first principles how to build this thing, and then later on we brought in the agronomists, and they were important eventually, but it wouldn't have worked if we'd started the other way around. So yeah, you do want to have the innovation and the evolutionary work happen separately from the revolutionary work. At the same time, there's a long history of knowledge from within companies that actuaries have that really is at the core of the business. It would be foolish to just swap it out. One example here might be Google. In the early days when I was at Google, all the search ranking was actually done based on a set of rules. And this was an increasing list of them. I think there were hundreds of them at one point. And some of them had names of the people who created the rules attached to them. So Amit Singhal was the head of search, and there was this A rank, which was named after him. And then they had this effort that was focused on, let's throw this all out as a bunch of rules. Let's use AI for this. And they put quite a few people behind this. And 6 months later, they looked at it, and the rule-based system was better by a long way. And they kept working at the other one for years before it finally got good enough that they swapped out the rule-based system for the pure AI-based ranking system. So you got to look at reality. You throw the baby out with the bathwater, and you're really hurting yourself.
I think that's a really great point. And you can kind of counterfactually imagine a world that didn't have any uncertainty in it, and it was full of data, and your predictions were 100% always going to be 100% correct. I don't think actuaries would exist as a profession. I think where actuaries are particularly strong is in the ability to take very sparse and incomplete data and kind of make kind of good calls about what will happen, and apply structures to things, use heuristical reasoning. And I think that's a key skill set. I think it's an important question to ask, like, what is an actuary when you break it down functionally? It's certainly the ability to use data, but it's a huge area of can they deal with uncertainty and ultimately structure uncertainty. I think the world there will be the kind of data, the ratio of data to uncertainty will change because the world will emit more data. I do think the role of actuaries will, in a long term, next 100 years, will probably decline. And I also think there's a very practical point, which I think Will alluded to, which is most insurance companies globally will have 500 different pricing models, let's say. Who is going to maintain these? They can't obviously be changed immediately. So there is very much a kind of balancing short-term pragmatism against long-term, shifts in accessing data.
Makes sense. So, Mike, how long before your role is replaced by the Chief Data Officer role?
No, I don't think it ever will. But we definitely need more data science, I think, in insurance, in large commercial. There's no doubt about that. I think the data scientists can probably learn something from the actuaries. I mean, the actuaries didn't force their way in; they were invited in, and we might not understand why, but I mean, I think it's they get paid handsomely for what they do. So I think data science can learn from that. But I think I also just wanted to mention scientists more generally, and just not forget them. I mean, so we have a lot of science in our predictive modelling in our business. In the physics, the laws of physics are important in predicting the impact of earthquakes and windstorms and hailstorms. And really the role of AI in helping us use that kind of predictive methodology is all about the data. If you know what a building's made of, it's and how tall it is, it's a lot easier to predict what's going to happen when there's an earthquake. And we don't need statistics to help with that, but if you can use AI to improve what you know about the building, then that definitely helps you predict.
Yeah. Sorry, Richard.
I was going to say, I think that's a really good point. I think that the data acquisition is a big thing that's becoming valuable. Because it just changes when you don't have data, you make kind of heuristic calls. You can't view things as optimization problems when you don't have data. So you reason your way through it. But with data, you can turn things that weren't prediction problems into prediction problems. And there's a massive deflationary value to an insurance company when they think about an expense ratio. But in some areas, you have data. So in SME, you have a lot of data. It can be turned into a very pure prediction problem. But to Mike's point, if you're trying to predict a catastrophic event that's only happened once in 300 years, you don't have data. You can simulate it, but it doesn't feel such a pure prediction problem. It feels more of a kind of structure problem, which is you think about it in terms of power laws. And some of the early kind of risk modelers of RMS, when they're thinking, how do we build a terrorism model, they didn't have enough data to build a kind of data-driven model. So they thought about it in terms of, well, let's just think about it structurally. Is it more likely to, is a terrorist more likely to kind of bomb the Empire State Building than a farm in Illinois? Like, certainly yes, but that's a heuristic way to think about it.
So, and clearly those skills have been in insurance for some while. The data science skills are new, and they're also new everywhere else. And so, you know, if you're trying to hire an actuary, you're competing against other insurance companies. If you want to hire a data scientist, you're competing against multiple other industries, some which are sexier in terms of what they're doing, some which may pay more. What about the battle for talent when it comes to needing to build up a pool of good data scientists? I'm not sure if you want to start with your thoughts.
I can't imagine a sexier industry. Just kidding. Yeah, no, that's a real problem. I mean, we see this as venture capital investors now. There's this war on for data scientists. There just aren't enough of them. And you know, the very best are either going to startups that they really are keen on and bought into, or companies like Google or Facebook that are attractive for obvious reasons. So it's very, very hard, even for startups sometimes, to hire these roles. So to say, you know, we're going to build a data science team, hire amazing data scientists, and do this ourselves, I think it's really not realistic. It might be in 5 years or 3 years, depending on how things go. But the reality today, what I would suggest if people want to build in-house data science teams, find, you know, your best and brightest internal people and train them up. It really is not that hard. You know, data science is.
And these are best and brightest in the actuarial department, in the IT department, in the underwriting?
We wouldn't call it IT, otherwise you wouldn't be able to hire the best people. Again, no, software engineering. You need a software engineering team that does this. And you might have that, and you might be calling it IT, but if, again, you know, it might be time to restructure that a little bit.
Good. Will, thoughts on that? Is the industry going to not be able to make the most of this potential because they can't hire the talent?
I don't think we should be too pessimistic about it. I mean, of course, there's a battle for talent, and of course, you know, I imagine if you're at the top of the food chain, you may rather work at Google than XYZ insurance company. So yes, but again, I don't think the industry should be too depressed about how that is a limiting factor. I mean, first of all, you know, if we just park the money subject, to the extent that my understanding is that people who are involved in technology are interested in the bigger picture of the social good and the value of the activity they're involved in, there is almost no better industry than the insurance industry, where you can argue that the industry is fulfilling a social good in an incredibly inefficient manner at the moment. And therefore, if you can bring technology to make that process better, that's hugely value added. So again, to the extent that non-financial things matter, that's a massive draw for anyone to work in insurtech. Not necessarily insurance company, but in insurtech. And I suppose that then is the second distinction. Well, then how do you pay them? First of all, don't underestimate the amount of firepower that insurance companies have. I mean, again, you know, to be clear, we're not Google. But you know, if you just think that my understanding from some consultancy work is that the amount invested in insurtechs since 2012 is something like $10 billion. That sounds like a big number. Allianz's annual dividend is about $2.5 billion. That's just one company. The companies I'm covering, they have billions of IT budgets that they are desperate to be realigning and making more efficient. So again, may not necessarily mean that they can do the sort of paychecks and they don't have the same cultures that some of the other tech companies do, but the money's out there. And I think also, in last point, this is probably why, you know, the insurance industry is more open-minded about the partnership model, because that can be then how you can square the financial equation and sort of say, okay, you guys can get involved in helping us work better, and we can sort of effectively split the gains, and you can have more leverage in that because, you know, you don't have to be an insider just getting the paycheck. You can be an owner of your business. And I think that is probably one of the reasons why the guys at the top of insurance companies have become so open-minded about the partnership model, because it is a great way of getting the talent and maintaining the incentive.
And so if someone came to you in your organisation, or two people came to you, one said, hey, I'm a marine underwriter and I've worked out that we can use AI to analyse all this data about ships and whether or not they may break down in the middle of the ocean. And someone else comes along and says, can we use a natural language processing to read all the annual reports of these companies to work out which ones sound, you know, better or worse in terms of insurable risk? How would you choose which one you would put your team to point towards?
I'm not sure. I think you know, I think right now people would say that they know what's a bad ship. You know, they know what a bad ship management looks like, but they can't tell from the information that they're presented with at point of underwriting. You know, they're not given the information about the ships. They're not given the information about the way that the ships are managed. So let's use AI to acquire that information, rather than using AI to try to spot which are the bad ships and which are the good ships at this point. I mean, I think, you know, maybe in another 5 or 10 years' time, then, you know, we will have more information, if you like, about near misses, for example, at sea, and we can start to use that to build predictive models.
So Larry Page at Google would say, "In God we trust, everyone else bring data." Something he'd like to say.
So this is a little bit to Richard's point, that if it's an emerging risk and there's no data, AI is not the right tool right now.
Yeah, I mean, you cannot really model these sparse, highly infrequent risks using machine learning if you don't have the data. I mean, you have to be able to distinguish between you have to have enough combinations of things that lead to certain outcomes that you can start to draw conclusions. But then, just to answer your question, if somebody came with these two propositions, say, okay, well, show me the results, backtest it, and show me how it looks. And if it looks amazing, then you probably want to spend some time understanding it further.
Yeah.
And this is a good hinge to the previous point, which is insurance companies are not good at collecting data. Their internal data is not in good shape. It's very hard to attract data scientists for that reason, because when they actually look at their raw material, they think, well, it's not actually that exciting a problem because they have like structural limitations. Another kind of facet of this is often, even if you're a data scientist working for, say, Allianz, even if you do build a really good risk model, an underwriter will still discount the price. So if you're looking for line of sight into the outcome, which is I'm looking to achieve better premium adequacy or a better loss ratio, but ultimately you don't feel in control of that, that's not a very motivational place to work. So I think insurance companies certainly can think about the incentives as well around how to hire and retain talent. I think that's important, and that's where I think automation is exciting, because it kind of it gives more agency to the person all the way through the problem, from let's ingest the data to predicting a price, and then they can actually see the reward of that in terms of profit margin. Netflix, that's the key value for Netflix, is let's do profit enhancing things. If you're trying to get data scientists to work on things that they don't see being realized, they're going to leave ultimately. So.
Good, thank you. Okay, round of applause for the panel, please. Thank you.